Hello and welcome to Class 8 Personal Finance. Let's talk about a three-fund portfolio. In another video, I talked about a four-fund portfolio and kind of setting it up, and I want to try to simplify it. The three-fund portfolio is usually the gateway drug into index investing, and it's probably the best way for a beginning investor to start, whether one is starting for the very first time or if one is firing a high-cost financial advisor. Let's go to this three-fund portfolio here. Let me find my mouse cursor for one, and then we'll keep going. And let's go to the three-fund example that I've pulled up here. Earlier, in another video, I had a four-fund example. Let's simplify. Let's go three. So we have a stock and bond allocation percentage right here. Stocks and bonds are going to be your two basic asset classes, and you need to figure out on your own what that percentage is going to be. Let me give you a couple rules of thumb and kind of give you my thoughts. One of the rules of thumb that's really out there is a variant of age in bonds. Now, note I did not say Asian bonds. I said age in bonds. So let's say that you're 35 years old. According to the age in bonds rule, you would be 35% bonds. Now, that's kind of old advice because the bond market simply isn't returning what it used to. That rule was incepted probably somewhere in the 70s or early 80s at the latest, and it's just not going to work out, I don't think. I think it's too conservative. Now, you could go age minus 15 and be pretty close. I happen to be 37 years old, and I happen to be 80% stocks, 20% bonds, so I'm pretty close to that. I would go 22 if I were really following that to a T. You might just want multiples of 5 just to keep things simple, multiples of 10, and that's all fine as long as you know what you're doing. Now, by age may not be the best thing because personal circumstances vary. You could be trying to grow things to make a large inheritance for your loved ones, and you happen to be older, and so you're just kind of throwing age out the window, and you want to have that risk, and you want to have that return for those who are inheriting your assets, that kind of thing. So age might not be the best thing because people's lives are different. This is a personal thing, so you've got to think about it. Another thing you have to think about, again, very personal, is risk tolerance. So this is 80% stocks here. So if the market crashes by half, and this is, say, a $100,000 portfolio, a market crash that takes out half the stocks will take out $40,000. Is that the kind of risk that you want to be taking? If not, then you probably need to increase the bond percentage. If you think you can take that kind of crash, and by the way, we just had the crash in 2020, and so at least those of us living in this time period have a bit of a litmus test to think about if you were already invested in the market and you saw it crash and you kind of had that feeling of kind of going, ooh, yeah, I lost quite a bit in that, but I also stuck with it, and hopefully we all turned out fine. Some folks completely left the market, and now they're full of regret because the market recovered. But in any event, what I'm trying to say is don't have more than twice what you can handle in losing in a crash in this stock percentage. So if you can handle a 40% drop, 80% stocks is probably okay. So those are a couple of rules of thumb. Now let's talk about the next step, which is choosing your domestic to international percentage, or your percentage of U.S. stocks to foreign stocks. I prefer 60-40 here. Can this be a personal thing? Yes, but there are sound folks who will give you a number anywhere between 0 and 50. I've even seen a 60 at one point. I like 60-40, and here's why. This pie chart on the right comes from MSCI. This is the All Country World Index, all cap index, if you're going to be particular about market cap. And note that the U.S., as of this publishing date, I think this is the end of 2021, the U.S. is about 60% of the world stock market. Now, I happen to be American, and the world sort of revolves around us, kind of, sort of. It's nice to have a percentage that's world market cap where it's slightly greater than 50%. So in a sense, 60-40, in my opinion, is sort of a neutral position. Now, there are a lot of folks who will say this should be 100 and Zero. You should be 100% US and 0% international. And one of the big arguments for this is that the US stock market is already very heavily invested internationally. I mean, think about Russia right now and all the US companies that were heavily invested in Russia, and now they're trying to pull their things out, and Russia is kind of doing their thing with that. Guess where Apple is manufacturing things? China. Guess where Microsoft is selling software? China. That kind of thing. So yes, U.S. companies do have a lot of international exposure already. I would also argue that the international side is also doing a lot of business with us. So why not diversify? I like 60-40 as a diversifier. Some folks will tell you 80-20 because they say, hey, U.S. is prime, but you might as well spice it up a little bit with international just in case. Personal decision. I used to be 70-30 for a long time. I like 60-40. Here's another thing to think about. On the Bogleheads website, if you haven't seen bogleheads.org, you need to. They have a good forum and they have a good wiki with a lot of information. This is the domestic international page on the Bogleheads site, and you'll note this. A lot of this is back in 2008. So since 2008, the international market versus the U.S. market has really underperformed. And so a lot of this information is out of date, but this did drive my initial decision making back in the day. This is an efficient frontier graph. On the y-axis, you have the return from 1970 to 2008, and on the x-axis, you have the year-to-year volatility, how much things go up and down. Here's why I think international investing really is important, and this ought to drive a lot of your decision, is that when you add more international, you can actually, here's what would have happened, I'll say, is that the return actually went up without increasing volatility by diversifying into international. So if you were 90% US, 10% international, you would have been here. 80% US, 20% international, you would have been here. 70% US, 30% international, you would have been here. Now, there are ways to figure out how this is going to look later on. I'm tempted to kind of deviate from my plan. I really am. Let's do it. Let's actually do it. I'm going to go to portfolio visualizer for a moment. So I'm completely unprepared for this. It just came to mind. I was like, I've got to check this. So we're going to backtest a asset allocation here. And we're going to say U.S. stock market and global X. I'm going to say international developed X U.S. market for a reason. Am I even selecting the right one? Hold on. Give me a sec. Historical efficient frontier. That's what I wanted. So we're going to say U.S. stock market here and international developed market. And I'm not going to put allocations there because I just want it to tell me the answer and see what happens. So it says the time period was constrained 86 to 2022. So note, this is saying total U.S. market would have been the right answer probably because the international market outperformed so much. Also, we have the data constrained to 1986, vice 1970 on that other graph. But let's see if I can fix that. Can I fix that? See large cap. No, 86. I'm disappointed. I'm disappointed in myself for deviating. Now, the other thing is, what if we constrain this to 2008? Is it prettier? Yeah. So this is saying it would have the correct answer would have been somewhere right here. Here's the tangency portfolio, and it's saying 5% international developed ex-US market. Take that for what it's worth. So here's the thing. You just don't know what it's going to be in the future. Now, we know now, okay, did you know in 1970 that this was going to be the answer come 2008? No. but I like having a neutral position so that, I have access to the returns of the international market as well as the U.S. market, and you just don't know what's going to happen in the next 30 years. So just take it all. That's the whole point of index funds anyway. Let's regain our bearings here. So we have 60-40 here, and this is math that you know how to do. So 80% of 60%, you could do this in your head. 6 times 8 is 48, move the decimal point, 48%. 8 times 4 is 32, move the decimal point, 32%. So you have 48% in US stocks, 32% in foreign stocks, and, bless you, and 20% in bonds. So now that we have those percentages, we need to figure out what we need to have for those particular allocations. Bless you. You okay? Give me a 5. All right? Ow. All right. So we have these 3. Let's figure out which funds we want to put in there. So I have 3 fund portfolios organized by provider here. Vanguard used to be, well, let's say they still are kind of the king when it comes to index funds, and they're really diversifying a lot more into ETFs lately. I don't recommend Vanguard for starters. I really don't. They've had some serious IT issues, some serious customer service issues, and if you look up my name, Garrett O'Hara, Vanguard, you will find an article by Aaron R. Vedland at the Philadelphia Inquirer. Over my vacation in August, I spent 45 minutes on the phone with the journalist at the Philadelphia Inquirer talking about my experience with Vanguard, and I ended up in a newspaper. So that kills my hopes of ever being employed by Vanguard, so I might as well just say what I think. Vanguard is starting up a advice shop here in the Dallas-Fort Worth area. They're going to build a building and then have this call center, and I will never be employed there. Oh well. At least I'm honest. So we have the U.S. stocks columns here, the foreign stocks columns here, and the bonds column here. So unlike every other YouTuber that says you have to stay tuned to find out this or that, don't stop watching until I tell you at the very end so that I have my watch time and all that. No, I'm just going to tell you up front. You could stop watching the video right now and just pick 3. I mean, you could. Bye. Say bye. Bye. Okay. But I'll also explain why I picked these funds if you want to stick around. So we have, let's go ahead and go to Fidelity here, just as an archetype, and we'll go from there. I can't have you on camera, okay? Can you stay right there? All right. I try not to show my pictures of my kids on the public internet. So we have this right here, which is the Fidelity Total Market Index Fund. So what I want to do is show you some things to look out for. Biggest thing to look out for is this expense ratio. 0.015% is really, really good, really, really low. Let's compare that with the other 2 here, which I should have pulled up. SWTSX is the Schwab one. Usually, for initial fund research, I like going to the horse's mouth. I like going to the actual provider of the fund. Well, let's see. Schwab Total Market Index Fund, net expense ratio 0.03, also very low. Now, does this mean you should always go with the absolute lowest? No, not necessarily. It just needs to be something that's very, very reasonable. 0.015 is reasonable. 0.03 is very reasonable. Then you can come down here. You can see portfolio. If you can memorize names, Apple, Microsoft, Amazon, Alphabet, that's Google, Tesla, NVIDIA, Berkshire Hathaway, Meta Platforms, United Health. Whereas you go to Fidelity, and let's go down to top 10 holdings, Apple, Microsoft, Amazon, Alphabet, Tesla. I think this has to do with the date as of. So note that this is 12/31/2021, and this right here is as of market open 12/2/28. That's why they're going to be a little off. Don't worry about that too much. But do some checks and make sure that it is a total market index fund and it's saying what it is. Make sure that it is what it says it is, if you will. It's also good to note the particular index that it's tracking, especially if you're in a taxable account, because if you're doing what's called tax loss harvesting, then you're going to have to know that. Another video. I'm not going to tax loss harvesting right now. But the index that this is based on is Dow Jones U.S. Total Stock Market Index, which is fine, and it happens to be the same one that the Fidelity one is based on. Finding total stock market index funds is pretty easy. Now, let's pull a VTSAX, which is Vanguard's fund. And I'm going to show you something here. Vanguard's funds are hard to find when you search for them because their page titles aren't descriptive. They're just a Vanguard fund profile. You just have to assume. A bold new look. So note the expense ratio here is 0.04. Not a deal breaker. It's a totally fine expense ratio. I'm not throwing rocks at that. But in Vanguard in particular, there's a $3,000 minimum investment for normal mutual funds. Now, you could go for the ETF if you want to figure out how to buy and sell individual shares of ETFs. Okay, there's nothing wrong with that. But if you're a beginner investor, I think it's just too much to sign someone up for. If I'm guiding a new investor, I'm just not going to go straight into ETFs necessarily. So, and if you're going into the Vanguard and you're using the normal mutual funds, you have to build up $3,000 before you even invest in this fund. You can build up $1,000 and go to a total, do a target date fund once you have the requisite amount of money to go into the individual mutual funds. You could exchange into those. I just don't think it's worth the hassle, one, between the $3,000 minimum investment, and two, the IT and the customer service issues that they've had. I'm saying stay away from Vanguard mutual funds. If you use the ETF, the exchange traded fund that trades like a stock, you can go with any brokerage that you want. But it's just not a good idea, in my opinion, to go with Vanguard brokerage in the first place, let alone have to build up $3,000 as that minimum investment when you could be going with Fidelity, which has a good platform and has a $0 minimum to invest with an index fund that is cheaper. Again, the Vanguard expense ratio is not a deal breaker, but the Fidelity fund is just superior in every way, in my opinion. If we go to, did I pull up? I had Schwab in this tab, didn't I? Let me double check. So you are, again, minimum initial investment, no minimum. Another thing to check, the net expense ratio is 0.03, which is great. Those are nice low expense ratios when you're looking at funds to invest in. Let's go to the foreign side for a bit. Better yet, let me show you one more thing. Under index ETFs, we can go back to the Schwab here. So I'm going to go back to the Vanguard page, and then you look at also available as an ETF. So right here, so this link is going to give you VTI, which is the ETF share class for the Vanguard fund. And note the expense ratio is going to be 0.03%. And because it's an ETF and it trades by the share, there's pretty much no minimum for this if you're going on the ETF side. There are some reasons to do that. But I think for beginner investors, I think mutual funds are just going to be easier. They're easier to exchange. They're easier to rebalance, to make automatic investments on versus ETFs. I happen to be in all ETFs, but I'm a little more involved in the portfolio, and you just may not want that. But I'm just going to highlight the fact that the ETF exists, and the Vanguard ETF, as with all ETFs, does not have a minimum investment. So let's talk about the international side. I'm going to pull up FSPSX. Now, this is where I get into my opinion that happens to diverge from a lot of people. And it also goes into why I tell folks, or why I'm saying rather, that you need to know the index on which your index funds are based. because that's going to influence what's actually in there. So Fidelity International Index Fund sounds pretty vanilla. You've got $0 minimum to invest. You have a 0.035 expense ratio, which is great. And you'll know it's based on the MSCI EAFE index, EAFE. What does that stand for? Europe, Australasia, Far East. I just totally killed what I was talking about. Let me bring this back here. And you can see under here, you have the top 10 holdings, and note these are all foreign companies right here. Can I get a country breakdown on this? Let's see, composition. So sector's cool. It is large blend. We knew that. It's the international equities. We knew that. Now, note on here, I like this part actually. Note that this says developed markets and this says emerging markets. Developed markets, 99.96, basically 100%. And emerging markets, 0. And you'll see under country diversification, you have Japan, United Kingdom, France, Switzerland, Germany, Australia, Netherlands, and so on. Unfortunately, Hong Kong there. So this is just one of those things. It's one of my things, and I think I'm right, obviously. But okay, so the EAFE index, EAFE. I don't see it mentioned here, but no, it's based on the MSCI. It used to stand for Morgan Stanley Capital International. I think it actually is just plain old MSCI now. And EAFE stands for Europe, Australasia, Far East. This is a developed markets index fund. What are developed markets versus emerging markets? Now, here's MSCI's website. I'm going to move this over a little bit. And MSCI splits, and as with all index providers that classify countries, will split the market, split the world into developed markets and emerging markets. So under developed markets, you have pretty much Western nations with the exception of Hong Kong, if you will. Canada, US, Austria, Belgium, Denmark, Finland. Is Japan Western? Okay, well, I mean, what I mean is that it's a developed economy. Perhaps developed economies are going to be the new West, if you will, because you got to admit Japan is still really, part of this whole international community, as with a lot of these European countries, right? So you have these developed markets countries here. So when you're talking about the MSCI EAFE index, you're talking about all of these developed markets countries except for 2. One is the US, obviously, because it's an international fund, and the other is Canada. Why? Because EAFE stands for Europe, Australasia, Far East, and Canada is not in any of those places. So I wish Canada were in here, but it's not. And it's oddball because there is an ETF, and I'm invested in this one. Let me switch back. That tracks an MSCI index that includes Canada. This is an ETF called, I clicked the wrong one. That's okay. iShares Core MSCI International Developed Markets ETF. And it's pretty much just like EAFE, but it also includes Canada. So it has all of these developed markets countries except the US. It includes Canada. So I don't understand why the EAFE index is still so popular. Nonetheless, I'm trying to keep things simple in this context. So this is an international fund, and it'll do just fine for an international fund. But you need to know when you're looking at the indexes that these funds track, this one doesn't have Canada in it for what it's worth. So let's go on to the next one. Let's try the Schwab one, SWISX. Schwab International Index Fund. Oh, you'd better load. You'd better load. There you go. Net expense ratio, 0.06. Totally good. Good expense ratio. It's also based on the MSCI EAFE index. And so at that point, you kind of know, okay, it's going to do pretty much the same thing as the Fidelity Fund. Now, under Vanguard, I put VTMGX. Let's look that up. VTMGX. And this is Vanguard's FTSE Developed Markets Index mutual fund. And why do I point that out? Again, I'm a stickler on making sure you know the index that this is based on so you know what's going on inside your funds. Again, we're talking about a $3,000 minimum investment, so that's why I don't recommend going to Vanguard's mutual fund platform. The ETF symbol for this is VEA. These are the same fund. They're just two different share classes. That's how Vanguard organizes them. So if you do the ETF route, you could invest in this one. And note that this is based on, where do we find this info on the site? I know this info, but under portfolio, give me an index. That'll work for now. FTSE Global All Cap X US Index. What's FTSE? Financial Times London Stock Exchange. Financial Times / London Stock Exchange. So, and under FTSE here, we have this country classification, September 2021 annual announcement. This is apparently the latest one, because I guess they update in March and September. So they have their own chart here. Let's blow this up. We have developed markets. And no, let's bring this back here. Okay, so we have the developed markets here, and we have emerging markets. They split emerging markets into two, which is fine. And I want to show you something. One, Russia is not going to be an emerging markets country. Pretty much isn't an emerging markets country for much longer. I think they declare. I know MSCI declared it a standalone, so it's like it's not even in these classifications. And note, under developed markets, one, you have Canada here. So FTSE doesn't have its own EFI index. That's an MSCI thing. So if you go with the Vanguard fund, you're getting Canada in there. Another thing you're getting is South Korea. And I really think MSCI needs to upgrade South Korea to a developed market. Because you look at this, that's not it. They call it just plain old Korea here in this chart. I don't think Korea belongs in the same column as China in terms of the market being developed. Now, okay, you're going to ask a question. Why isn't China developed? Okay, there are specific criteria in terms of what investors are able to do in markets that determine developed versus emerging markets. I know it's not countries or economies, it's markets. It's the markets that are being evaluated. I think looking at Korea, it should be considered a developed market. So if you go with these MSCI EFI index funds here, like these, FSPSX, SWISX, you're unfortunately not getting Canada. You all are also unfortunately not getting South Korea. I think Poland is another one of these also. They're going through some political stuff right now. Poland right here is under emerging markets. Right here under FTSE, Poland, right there. Did they upgrade Israel? They did upgrade Israel. Israel's a developed market now. But you get the idea. There are going to be little differences between one or the other that you should be aware of. Now, for a basic investor, you don't necessarily need to worry about it, but you should at least be aware, I think. And if you're on the ETF side, then you could even include a Canada ETF to supplement it if you really, really wanted to, if you're mixing different account types. That's what I happen to do, but that's too much in the weeds. So just note these differences. And now let's go to bonds. Let's try FXNAX. Again, one more exercise to see what's in these funds. So here, FXNEX is the Fidelity US Bond Index Fund. There are also international bond index funds, and Vanguard even has a world bond index fund. I just don't think international bonds make a whole lot of sense because bonds are for safety, and so I think they really should be in your own currency. A lot of international bonds are actually have negative interest rates. And don't ask me how that works. I've gone through some videos to try to figure out how do those even work? Why do people even buy bonds with negative interest rates? And they do. And I can only guess that they think the interest rates are going lower. And so when the interest rate's lower, then you can resell your bond for a higher return. But it's like, yeah, I'd rather just hold the cash. In any event, Fidelity US Bond Index Fund has a very low expense ratio, 0.025. It's based on the Bloomberg US Aggregate Bond Index, which is fine. Now you can look at the portfolio. Let's see under composition, and then see that it's got 40% U.S. Treasuries, 25% corporate. It's got 27%-ish MBS. That's a bad word. Mortgage-backed securities. Remember the 2008 financial crisis? Mortgage-backed securities, yeah. Should you worry about that too much nowadays? No, I think they've kind of solved what the issue was. You okay? You okay? I'll get you in a bit, okay? You hungry? Yeah. I'll get you some food in a bit, right?
I saw some ants over there.
Oh, thank you for broadcasting to the internet that I have ants. Yeah. Okay. We're going to go kill some ants in a bit. So you have this bond fund here, and you can look at the rest of that. I'm not going to go through the rest of this too much. I think we need to kind of retire it out. But again, now you know how to research these funds and figure out what you want to do for yourself. So when you figure out what you want in each of your accounts, you may have a Roth IRA plus an employer account, for example. You have to figure out, okay, I could start my Roth IRA with Fidelity or Schwab. I can choose these three funds and have them in certain percentages. Then in your employer account, do the same thing with these percentages, but you're going to have to look inside your employer account, look at a fact sheet, and figure out what you're looking at, find expense ratios, and go from there. One final word, don't buy a loaded mutual fund. That is a mutual fund that charges you on the front end or even on the back end for your investments. Go with something that's just a plain old expense ratio, because usually a loaded mutual fund is a load of garbage. That's another video. It's my story of investing. Thank you for watching. This is Garrett O'Hara with Class 8 Personal Finance. Leave a comment if you have a question, and have a nice day.